This is Bloomberg Markets. We are less than an hour away from the Federal Reserve's latest interest rate decision. The central bank expected to raise rates another 25 basis points. But the messaging on the path ahead is as important, if not more so. Now, clearly, the Fed would like to keep the door open towards more action since inflation is still a worry, but we've been covering all those jitters in the banking sector, and yesterday was a great reminder that sentiment remains fragile. We saw one of the key regional bank indexes in the U.S. at its lowest level since 2020. We referenced earlier the fact that our own financial stocks in Canada had their worst day since March yesterday. And that has been puzzling to some after JP Morgan's acquisition of First Republic to kick off the week. Regulators had hoped that would soothe some of the investor angst. JP Morgan's CEO Jamie Dimon himself had declared on Monday the worst of the uncertainty may be over. So if you're the Fed, can you risk further exposing the weak underbelly of the U.S. financial system, i.e. these smaller lenders, through a commitment to more tightening? And if you can't, does that risk kicking the inflation can down the road? Well, earlier we spoke with Nouriel Roubini, the well-known economist who predicted the 2008 crisis, who talked about the challenges ahead for the U.S. central bank. Here's more from that conversation.
The Fed has a mission impossible right now because they have to achieve price stability, growth stability, and avoid the hard landing and financial stability. But unfortunately, inflation is still too high, and they have to keep on hiking, and that's going to imply the risk of more bank distress, of a hard landing of the economy, and an economic and a financial crash are going to feed on each other. But then if the Fed were to blink and wimp out and not raise rates enough, there's a risk of a de-anchoring of inflation and inflation expectations and a wage price spiral. So my baseline is still that eventually we're going to get a recession.
Meanwhile, it is no easy road ahead for our own Bank of Canada, which, yes, has already hit the pause button. But as we learned from the minutes from the recent Bank of Canada decision, is still thinking an awful lot about inflation. Let's get some perspective on both economies. David Doyle is head of economics at Macquarie Group, and he joins us here on set. Nice to see you, David. Let's just start with the Fed itself and what your expectations are today.
Yeah, so we think there'll be a 25 basis points hike. I think that's largely priced in by the market, and I don't think that will move asset prices very much. I think where the focus will be on the forward guidance and the commitment and the language that Chair Powell uses in his press conference. And there we think you'll see a little bit of a back down from their forward guidance, so less commitment to raising rates further beyond what they'll do today in our estimation. But nonetheless, we still think those hikes will be on the table, right? I don't think that they're going to abandon the possibility of further hikes completely. So in some ways, you could consider that sort of communication to be a hawkish signal for what could come down the line.
What Nouriel Roubini described it as a hawkish pause, which it sounds like you would agree with.
Yeah, I would agree with that sentiment. Yes.
So, and I guess for those in Canada who are watching the Fed's course from here, I guess the worry for the U.S. economy is, can the Fed get it right? Can they navigate? Can they avoid a worst case scenario for the economy? There are some who think maybe that is possible. Here in Canada, though, I mean, you had already warned that we might be headed for a recession. Do you still feel that way now?
I still do. I still think both the U.S. and Canada will enter a recession in the third quarter of this year. The one sort of component of both economies that's been holding up has been the labor market. Unfortunately, in Canada, we don't get all that timely labor market data, but in the U.S., you get a lot of it, and those data are evolving in a way that's consistent with a recession starting in the next few months. And by that, I mean initial jobless claims, continuing jobless claims, even some of the details of the monthly employment data are suggestive of a recession occurring in the next few months.
And I guess the challenge for Canada as well is, even if you're ultimately seeing a cooling economy, the question is, does the inflation worry go away, or are we headed towards sort of more of a describe it as a stagflation type scenario? What do you think?
I think it's going to take some time. I don't think that this is an easy battle for central banks to win, in part because of where we're coming from, right? Recall, we're not coming from a period where we've just had very low inflation and inflation has suddenly just perked up above target. We're now in the third year of elevated inflation, and that's going to create problems for them and challenges for them, and they're going to be worried about allowing that to persist for much longer. So in our estimation, they will err on the side of keeping rates hawkish for longer rather than prematurely easing and ending up with another inflation problem down the line.
And I guess the restriction for now on continuing with higher rates, which I assume would fight inflation, is the fear of what comes from that, like breaking banks in the U.S., or as you've talked with us about the sensitivity in our housing market.
Yeah, I think they want to strike a balance, right? If they go too much, then they risk causing too severe a recession and too much pain. But at the same time, they absolutely want to be sure that they've done enough to curb inflationary pressures and to bring inflation back down to target. So in our estimation, this will be the last Fed rate hike. But in our view, you'll see the data deteriorate from here, and so that will allow them to pause come June. If for some reason, that doesn't occur and you see strong data over the next 6 weeks, it wouldn't surprise me at all if the Fed hiked again in June, because again, their number one priority at this point in time is bringing that inflation back down to the 2% target.
Does that mean, and I know you focus more on the economics and a little less on the markets, but you're deeply familiar with the markets and what the market's thinking is, there are still a chorus of people out there that think the Fed might be in rate cutting mode by the end of the year. Some even arguing maybe the Bank of Canada would be there. And based on everything you're saying, it doesn't sound like you think that will happen.
Yeah, I'd be surprised if we got to the point where they're cutting rates later this year, both the Bank of Canada and the Fed. I just think that there's a long ways to go in this battle to get inflation back to 2%. We do think rate cuts come, but that's probably more likely a 2024 decision rather than something that could occur in 2023. And by the way, that occurs despite the fact that we expect this recession to start in the third quarter. So we think the second half of the year could be challenging for investors in that you're confronting a recession and at the same time central banks that might not be tightening anymore but aren't yet prepared to ease.
It has felt like a slow motion story, though. How will we know what kind of economic downturn, if that's ultimately that materializes? How will we know whether this is a shallow recession, something deeper? What are going to be the contributing factors?
I think we need to be laser focused on the labor market. And again, that's what's held the economy up so far this year has been the strong labor market. Again, we do see signs that is deteriorating. But that data will tell the story in terms of how severe the potential recession could be.